Good morning, everyone. Welcome to week 6. We are going to discuss today some of the important topics like rental property expenses, prepaid expenses, and other some small topics, mainly rental property expenses first half. Rental property expenses. The rental property, it is a investment property. Normally we call investment property. It is not a carrying a business. Normal rule that investment property owners not eligible to get that ABN for running that investment property as a business. So they not carrying a business, so they are not eligible to get that ABN for the rental property. Therefore, their rental income will be included with their normal income. Right. So if you make it that net income from the rental, it could be added with the accessible income. For an example, in your total rent, $25,000, your total expenses for the rental property, including interest and land tax and other all the repairs and expenses, $20,000. So $5,000 you are making the profit from that your rental property. That 5,000 will be added with your other income, such as employment income or any other investment income. If you're making loss from that your property, for an example, if your total your rental income $25,000, your total rental expenses $30,000, different between two, you making $5,000 loss. This loss will be deducted from in your other accessible income, other employment income or other business income. So this called negative gearing. Negative gearing mean we are reducing in our taxable income using that rental property loss. So that if someone is carrying a business like a hotel or motel or caravan, it is business. But this is the one, you are invest on that couple of small investment, couple of properties, you rent it out to the tenant to gaining some income. There are little number of things to be considered if you're running a rental property as a business. The normal rule, rental property is not going to be part of the business. So if you have a single owner, the total loss or gain or negative gearing will be affecting your individual income tax. However, in most of our taxpayers jointly own that the property. Jointly own the property mean they may have that husband and wife or brothers and sisters. They may be jointly own the investment property. In that case, they are profit or loss, or in other way, their income from the rental income or rental loss will be shared based on their legal interest of the property. So for an example, husband and wife, they purchase a proper investment property 50-50, that net income from the rental property or net income loss from the investment property will be divided based on their legal interest in the property, right? So very clearly you can see the legal interest mean which way they registered their property with the land registry, right, or the respective state land management departments. That's a different name they call each states, but that's a state level registration. So whatever that legal interest over there, you're going to distribute. Sometime that clients may ask that I am spending all the expenses, I am paying all the council rates and interest and everything. My husband not working. Can I put it all the expenses in all the expenses and income into that my income tax return? That's the meaning. So husband and wife were earning some income. Unfortunately, this year husband did not earn. So can we move into that all the expenses and income to that husband? Answer is no. We want to check with that what is the legal interest between both uh, or landlords or both taxpayers. Based on that only you can divide. You cannot change that one. That's good. Now we will move into the rental income usually allocated equal shares, but however that we want to see, most of the time they will be 50-50, right? Now I just listed some expenses here for you to just go through that. I will give you a minute. You can just read that. There are a number of expenses. We can take it out from that rental property expenses. However, I will explain this all through a zero practice manager. That's easy for you guys to understand where you're going to enter and how you're going to calculate that rental property expenses. If you look into that in our zero practice manager here, I'm sure that you're all seeing now zero practice manager. You can see in the zero practice manager, we will go back to the Steve Smith. He's in our lucky. So if you go to that in the new schedule and click the rental, when you click the rental, it will come up like this. So if you have how many properties, new properties, you can add the new one, or you can click here. It will add more and more property. You can see, you'll go back and see this Steve Smith in this example, he may have 3 rental property, different location. He may have 3 different rental property. Each rental property should be reported separately. That's easy for us. So I will click the first one. So you put it that investment property one, whatever address, right? You complete. Now we will come back to the first question. The date the property first earned rental income. But they're putting that 1st of January 2018. 1st of January 2018. So this is the critical date. Why this one is the critical date? Any expenses incurred before this date, normal rule is not deductible, because that only we can deduct the expenses after you earn the rental income from that property. If you not earn the income from the property, you purchase the investment property, you are keep it as it is, you cannot deduct your interest or land tax or council rates from your rental income, because there's no rental income. You cannot deduct that expenses. So this date is a very critical date. So you must ask the client what's the date you rented out the property, or what's the date the tenant move into that your place, or what's the date in your first contract, rental contract. So that's the date. Normally they knows that, or you can go to that our tax portal and find it out from the tax portal. This information will be there. If they have already have investment property, if the new investment property, you can get it from here from the client. So any expenses before this date is not deductible. So very clear, right? So for an example, assume that you are doing that tax return for 17-18 tax year. Assume this client purchased this property on 1st of July, 1st of July 2017. When he purchased, if you like, please write down, that's easy for you. 1st of July 2017, he purchased this particular property, and he rented out 1st of January 2018. So 1st of July 2017 to 2000, so 1st of July 2017 to January 2018, he did some repairs and improvements and etc. etc. And he rented out in that website, and he only the tenant moved into the 1st of January 2018. For the 6 months from 1st of July 2007 to January 2018, that 6 month, he did the repairs, he paid that bank loan interest, he paid that insurance, land tax, everything he paid. It is not deductible from his rental income he's going to earn from 1st of January 2018. The reason is that you must have an income producing activity or income producing activity to deduct your income tax from that date. So we normally not consider that previous part of expenses that can be included in your capital cost, and you could deduct through that depreciation or in any other way, but cannot include it here as a operational expenses to deduct from your immediate deduct from your rental income. So second question, so you can see their question asking how many weeks you rented for this year. Why they asking? The 2018, that's all right, you already rented. They want to check that this year you take it that your personal uh, you not rented out or any other reason. They are checking how many weeks you rented, and you can see the number of weeks property was available for rent also there. So when I talk about the 1st of January 2018, your tenant move into that your property. However, you may start to that advertising in the website or the real estate sites around 2 months or 1 month before. So that whatever day you advertise, so any expenses that's available for rent, so any expenses incurred to that getting a client like agent fees or advertising fees or that type of inspection fees, this type of expenses what to get the client in, that can be deductible from your income tax. That can be deductible from your rental income, right? That can be deductible from your rental income. However, the land tax or council tax and etc. cannot be deductible. Now we will come back to that other section that's called your purchase and sales detail of the your property. If you sold this property this year or any capital gain event happened this year, it's mean last 5 years you're keeping this rented out property. This year, middle of the year, you have some rental income and same time you sold it. In that case, that information should be given here, but otherwise it's not necessary. So we learned that this one under the capital gain very clearly, so we can use the capital gain schedule and use that. Therefore this is not much important to you. Now we will come back. What is the percentage? Assume that Steve Smith have 50% and his wife have 50%. So 50% ownership here for Steve Smith. And we will come down and you can say Steve 50%. You want to change it this one. And then you want to add it that Steve Smith wife. What's the name? Britain, or the first one, right? Okay, 50%. So we added that one. So what is the beauty of this software? When you do that Steve Smith income tax return, if you add it like this, that his wife tax return will be automatically update this rental details. You no need to retype any of these details. Automatically will go to her tax return when you completed this rental schedule. Now you add the owners, then we will want to give that income and expenses for the rental property. What is the income? We have the rental income. So that's we say $500 times 26 weeks or whatever, 26,000, 500 per week, 52 weeks. So this much of money you received in your bank account, that's you going to enter. You can see it's coming US shares. This is your Steve Smith shares. Because 26,000, 50% will go to his wife. So that's what you want all the time. Make sure that. Second one, you can see other rental income. So what does other rental income mean? Sometimes if the client did the damage in your property, you may go and get it from some insurance. So that insurance income should be reported here as a income. Also that whatever insurance repairs you made it, you're going to put under the expenses, right? Very clear, because you spend some money, that expenses will come up here. Repairs 500 is a more repairs, you can click the plus button and type, right? $5,000, but you got it the whole the money from insurance company 5,000. So both should be entered. If you get it only $4,000 insurance company, you put it only 4,000. Sometimes insurance company said no, we can give you only this much because rest of the stuff is not part of the damage or whatever. So whatever amount you receive from insurance company, it will go as a other rental income. Whatever amount you repaired, that will go as a your expense under that expense column repairs. So next one, the water. So normally that in the water bill, there's a two component. The component one is a usage, how many liter water your tenant use. And second part, actual service fees. Service fees mean you have the water meter and water connection and water facility and drainage and storage. This purpose, you have a service fee from the Desse Water or New South Wales Water or Victoria Water. That service fees normally belongs to landlord. Normally belong to landlord. We cannot consider that one as a deductions. So therefore, this insurance, the water bill, which is you are normally paid by landlord for the rental property, investment property. So whatever amount you are paying as a water bill, for example, you are paying the whole water bill, $3,250 for the whole year. That's good. But client should reimburse all the amount what he paid, what the usage of that is water. That will come as a income here. Water reimbursement or whatever repayment. How much? That's 3,800. You can see a difference because $3,800 here. How much? Three. So we'll say here 4,250 client paid. Total bill I paid to that water board, but client only paid back to us 3,800 because 3,000 that's a water usage. The balance belongs to landlord. So that's the one you want to clearly enter as the income. Sometimes people enter here the bond amount what you receive from that tenant. It is not an income because that's a liability. When he's leaving from the property, you want to give back to that money. Therefore, that cannot be considered as an income. Bond or that any deposit that client made cannot be considered unless they did some repairs. If you deduct some money from that bond, that going to be income. Otherwise, it's not going to be a rental income because that's just a liability. So that's the normal income you will receive. Any other related income if you receive, you can put it here. For an example, when you install a solar, you may be getting some solar rebate here. So that type of things you could include here. But mainly this is the two other income will fall into. Now we will see expenses. Advertising to tenants, I explained very clearly. The body corporate fees. This is called starter fees. What is that? Sometime that's a condominium or the group of building together, they manage all the operational expenses can be deductible. However, sometimes there will become as a capital component. If it's a capital component included, that one that will be taken out. But normal all the day-to-day expenses what you are paying for security or insurance, common security, common cleaning, this type, oh, that's management fees. This all the stuff will be called body corporate fees, right? For example, you are living in a big apartment or you rent it out one apartment for your investment property and there are 100 apartments in the block that will be managed by one body. That's called corporate fees, right? Body corporate fees. Borrowing expenses. The borrowing expenses mean to get the loan, whatever expenses, that's called borrowing expenses, right? I will explain through that in my PowerPoint slide in a couple of minutes. So if you get the loan, after getting the loan, whatever expenses, that will go to the normal expenses. So borrowing expenses mean if you obtain a loan from the bank, you may require some bank financial report from accountant. You paid some fees for accountant. You may require some valuation of your property, valuation fees. You may require some stamp duty for the mortgage. That can be included. So this type of all the expenses, what you to get the loan connected with the loan, that expenses can be considered as a borrowing expenses. Interest, it is not a borrowing expense. That cannot be included here. There will be several separate section down. Cleaning, Cleaning and gardening. There are two things I want to quickly explain. Is if you are client, if you did some cleaning that through that some professional people or some other businesses, that cleaning expenses and gardening expenses can be claimable from the rental income. However, most of the time when you do the tax return, client will come back and say, "Hey, I did that cleaning for that my investment property. I did the gardening for my investment property. Can I claim that same as what is the normal rate? Or I got a quote from that from a landscaper or cleaner. This much of that cleaning cost per month, or this much of gardening cost for 3 months. Can I claim this one?" Simple answer is, if the investment property owner do himself without ABN, that cannot be considered as a expense. But if he purchase any material to cleaning or gardening, such as small chemicals, or that's that washing liquids, or any clothes for cleaning or gardening required small tools, that can be deductible, but that your labor component is not deductible. So you should have a evidence for the materials and equipments you purchase for cleaning and gardening deductible. However, it is not deductible in your labor component, or that what you thinking just estimate. Council rates normally deductible. Um, uh, that other three component and the capital allowance, there are two uh, worksheets that will come up total here. I will explain to you what is that capital assets, and we have other one here also capital work. I will deduct. I will talk with you in a minute. Insurance, we have a two type of insurance. One called landlord insurance. Landlord insurance mean the loss of income. So, for example, tenant did not pay the rent, if you can claim from the landlord insurance. Second one, your building insurance. The building insurance mean insurance for the property damage. You can claim from that insurance. However, your personal contents insurance will be not included, because that's your personal home and contents insurance. You have a jewelry this much, your car this much, something like that. We do the insurance when we are living. That part is so not deductible. So whenever you want to advise to your client, sometimes clients are not taking out this part. When they rent it out the property, they want to take it out. So what I'm trying to say, the building insurance and landlord insurance both will be deductible. Any contents insurance is not deductible. Contents mean your car or your jewelry or your some assets inside the property. That's your personal assets. If that personal assets cannot be insured, and can be insured but cannot be deductible. Interest component. Interest component, so that most of this investment property owners, they have a loan. That loan amount, that loan interest will be deductible from uh, uh, rental income. Please note that the principal cannot be deductible. Only you can deduct interest component. Nowadays each banks, they provide that interest statement. You can ask the client, can you provide that interest statement? They will provide the interest statement from the bank, can say this much of interest for this financial year. That's the amount will be here. Land tax, we all know that revenue departments in the states, they are giving the land tax. The legal fees, this legal fees involved with that one. For an example, a tenant um, uh, um, uh, not paid the rent properly, you maybe go to the tribunal and use that your lawyer, that type of legal fees. The pest control, that maintain your house to avoid the pest, and etc. Agent fees, your property agent fees. Any repairs you made this property, you can add it. You did that plumbing, you did that some electrical repairs, and everything can be added here. But please note that you must have a proper substantiation. It's mean the receipts and payment details, as well as you must make sure that this is repairs. Repairs and improvements are two different things. The repairs can be deductible under the rental schedule here. If you're the improvement, like a extension of the kitchen or extension of that new pacola, this all will be considered as an improvement. That should go to the depreciation. Over the years you should deduct. But the repairs mean fix the defect. You fix the defect, that can be come up here. But if you are improving in that in your property, if you're replacing new assets, that going to be considered as a improvement, right? And that go to depreciation schedule, but we are going to work in a minute. Office supply to manage your investment property. If you're buying any stationery or printer or any other cartridge and etc., that will be fall into here. The travel between home to investment property to collecting the rent or maintaining the property or inspecting the property, not allowed. Not allowed. It's mean we cannot deduct. So that's stopped from the 2018. So we cannot deduct that travel expenses between home to work, home to investment property is not deductible from 2018. So we cannot deduct. So please not include any travel expenses between home to investment property. Don't include. Water, I explained. The sundry expenses mean anything not come under this above, but you sure that run connected with that rental property. For example, that they did such small items, they purchase and put it in, or repairs or whatever that's Bunnings, they purchase a small item for property. That type of items will be moving to here. Any expenses, sundry other expenses, miscellaneous, it's a operational nature, and you spend it not listed above. So now you know that all these different expenses. Only thing I did not explain, what is this capital asset? This is the depreciation for assets. Other one, depreciation for your building. So you can see capital works deductions, capital asset deductions. So in your rental property or your client's rental property have two part of depreciation, because the building going to be decrease the price. Land price goes up, but building, that's depreciate. So what does the building mean? Actual constructions and roof. Actual construction and roof. If you do that depreciation for that, that's called capital work deduction, which is in the down. So your building depreciation will come up, capital works deductions. Can you write down? That's called division 43. What does the division 43 mean? Capital work deductions. Actual that structure of the building and roof. That's called in your construction, right? Actual construction depreciation, that you can report in the two way. You can see one is the worksheet, one the basic worksheet, but this will come, both will come to here as a total. So now at this point, any building related, that's a construction and roof related depreciation, will come under capital work deduction. That's called division 43. When come back to here, capital allowance for assets. Assets mean in the rental property, there are a number of assets included. What are your air conditioned machine, your cooktop, your oven, your microwave, your rain shoot, washing machine, TV. So anything that smoke alarm, right? All these assets are attached with your property. That's called fixtures and fittings. So whatever fixtures and fitting in your property also depreciate. That's also can be deductible. How much we're going to deduct, we will talk in a minute. But first you should understand what is the difference between capital allowance, assets, capital work deductions. Capital work deduction mean actual building and roof. What is that capital asset? That allowance assets mean that anything attached with the fixtures and fittings such as air conditioner and etc. So all the asset depreciation you're going to enter here, all the building depreciation you're going to enter here, right? So there are two way you can enter. One, you can enter through the asset worksheet, other one asset basic worksheet. Now, as an accountant, so as a tax agents, we can easily calculate the depreciation using that tool, or we can use our own calculate. However, to calculate, you should have a three important information. One, what is the cost of the asset? How much accumulated depreciation up to today? and what is the effect, rest of the effective life. If you should have all three this information to calculate the depreciation. To do this, sometimes it's hard to find it out the information. For an example, a client come to you to do the tax return. You ask that, all right, you have the air conditioned machine. How much the cost of the air conditioned machine? Sorry, I lost that the receipt. Or they may say, I'm not sure. When I bought this property, I have that this particular air conditioned machine part of that my purchase of that house. So I have no idea how what the purchase price or any depreciation details. In that case, as an accountant or tax agents, we cannot determine how much that price or first of opening start of that financial year, what is the that cost of that one or accumulated depreciation, we cannot determine. Therefore, we should rely on that other professional. Who is other professional? Quantity surveyors, which is approved by Australian Tax Office to determine the value of the property and value of that assets inside the investment property. So we should ask them to client, go to that quantity surveyors and calculate the cost and come back. But in the real world, what we normally do, we can ask them to go to the depreciation schedule preparers. They are the quantity surveyors and tax agents together. They will prepare that report and give to us. This is the depreciation schedule. So depreciation schedule going to give us what is that, how much that assets depreciation for a particular year, and for the how much the depreciation for the building uh, uh, um, uh, amount. So now we will go back and understand how that look like, that depreciation schedule. So I'm going to use the depreciation schedule. If you can, you see here, BMT tax depreciation. This is a bigger company. They are the quantity surveyors. They are approved by ATO. You can see that what they're writing here. I can show you quickly their profile somewhere. Uh, Yeah, you can see they are the quantity surveyors approved by tax office. They are the tax agents and all the stuff. So they are registered tax agents. Their number is this, and all the informations are here. So when you go down, you will come first, right? Assume that this is the ownership 50-50. So they're preparing each taxpayer separately. Some companies preparing that full report for for the whole property. In that case, you want to divide by percentage, right? So they will clearly say this prepared as a one report. The based on the legal interest of the client, you should apportionment. This means you want to divide. But this report, you can see they gave to that only 50% of that one for that your client, so you no need to divide. So the first 143 mean what I said, capital works allowance. This is the one you saw that in our zero practice manager as a capital works in the down. So division 43 in your building, capital works, it means construction. So you can see construction, all the total cost they have here. Now they calculated and give you almost 40 years they gave. Some institution, some depreciation preparers giving 10 years, some of them are 20 years, some of them are 40 years. So normally it's 40 years is that for the lifetime of that building, for investment property mainly. So that's the reason they're preparing for 40 years. So however, that will be vary depend on the depreciation schedule preparers. So now this report will be with the clients. There's no need to get it every year. So once you get it, you can use that one all the time. So for example, if you are doing the tax return for 1920 or 2021, so how much you going to deduct for your capital work deduction? $2,422. So this is the schedule every year. When you do that, client will come up. Or if you upload this one in the client data file, which is we have, you don't need to ask the client, just go and open and work it out how much it is. right? So and get that information and put it. So every year you no need to ask. First year you want to ask, you want to upload that one. Second year is not necessary because you have this document. So that's so called capital work deductions. When you go down a little bit, you can see we have that capital asset deductions. Capital asset deduction. So this house has around $15,000 worth of assets as of that 18 May. So they calculated with the two method. First one is the diminishing value method. Second one is the prime cost method. This column is a cumulative total. It will add this one, this. So every time add and adding going, right? So we not use this one. We not use this column. We use that this column or your capital prime cost column. Other one, it's showing that what is the running balance. So what is that? 317 plus this much here. So that's we are not going to use that column. So we're going to use this column or this column. Now, when you look into that capital assets, you have two methods. This is called diminishing value method or prime cost method. So for example, if you're doing the tax return for 2021, which one you prefer, 2,458 or 1,356? Always we like to deduct more. So we will go to 2,458. However, if you go to that, if when you are doing 2017-28, which one you prefer? You have more with the prime cost. So can I move into here in this year? No. If you elected to one particular method, diminishing value, you must continue that method until you finish that zero. If you purchase any new assets during the time, you can decide. But for this one, for this 15,478, you go in with this method, right? You cannot move into prime cost. But any new asset you are purchasing for your property, that's you can choose your choice which way you like to go. But this one, whatever you elected, you must go. Therefore, before selecting this one, you must make sure that what is the method they used previously. So how we know that? You must check the previous tax return and how much this particular asset, how much this particular asset. So when you look into that, what is that method previously used in the tax return? If they use that diminishing value, you're going to select from diminishing value method. If they use that prime cost method, you're going to use that same method. So we must check with the previous year tax return to decide which method we're going to use for division 40, which is a capital assets or capital allowance for assets, right? This is the first one. So you have this all the information from that one, right? Now assume that your client got, this is a little bit expensive to get these reports. Normally client paying around $750 to $1,000 where a quality depreciation specialist. Some online they are charging around $400 as well. That's depend on the clients, but we always recommending some well established businesses doing this depreciation schedule, which is benefit to the client. They go up in person and check that all the property and develop that these schedules. That's the cheaper providers normally they do through the online and couple of questions and stuff. Sometimes they are missing that some deductions. That's the reason we always recommend to some of that reputed depreciation schedules preparers around the state, around the country. We are not doing that work, but it's expensive. Good. So if for example that client have this one the 40 years, but he come into here and say, oh yeah, I purchase a new TV for my investment property and fix it inside. Aha. So that's not included in this $15,000. So are we going to ask to the client, hey, can you go back to the depreciation schedule preparers and prepare again this report and pay $750? You cannot ask because you have all the information. You can ask, but you have all the information. You no need to ask. Why? You have the cost information, purchase the TV price. You have that information, what is the effective life. You can find it from the ATO. So now simply we can calculate the depreciation. So any new asset purchase, you're going to calculate, right? Now I go back to that our zero practice manager and show you where you enter this information. So I will share it, this one with you guys. Here it is. So anything assets, you can write down division 40, come under the assets. You can see there are two worksheets. The first one asset worksheet, other one basic worksheet. So click here what the basic worksheet. You say BMT depreciation schedule preparers. You say how much that one? Whatever 1524 or whatever number from that particular year you're going to include. That will come up here. Good. If your client purchase anything this year, you go to this worksheet and enter what he bought it, TV. So TV and TVs come under that general. I put, sorry, I can put the plant and equipment maybe. So we said that 1/7/2019, and he same day he put it in that. Uh, that's right. Yep. I'm doing 1920. Yep. Said same day you put, so 366 days. And he said that 1500 he purchased. Say he's using the diminishing value. No matter, because new asset you can decide which method, prime or diminishing. You cannot use any of this one unless less than 300. So diminishing value, I will explain that how you select this one in coming weeks, in a couple of weeks time under the depreciation. Diminishing value. So how much effective life of the TV? We say 4 years. I will explain to you later how you get it, that one. So you got it 4 years. You have that your depreciation $752. So if you go back to that your render schedule, now you can see where's that in our assets. So $752 for the TV. This is the one, the whole assets, the BMT depreciation specials or whoever depreciation schedule prepares us did that total here. Every year they purchase new item, you're going to add here because this will be remain same. Right? Good. So but this will be remain same in every year. You want to go and get it from that depreciation schedule preparers and change this one. What is that particular year? For next year, maybe 1425. Right? You just use that table and put it here. But other one here. When we come back to down, capital work deduction, same way, anything come from the depreciation schedule, it will be here. Your client maybe did that a new driveway or kitchen. So if you did that a driveway, you're going to put that here, driveway. Oops, that's right, nice. Right, and put it that that's coming to the building, and he did that 15/7/2019, and from that day he's going to start and work, use it, and he spent it how much, 15,000 for driveway or kitchen expansion or whatever. He's going to use the prime cost method. 2.5 is a 40 years, can be used the driveway. How I know that I will explain later, right? What is the, how we got this number? There will be a rules called depreciation rule. I will cover everything together. So now you can see $362. So in addition to that depreciation schedule, this 660, 364, $362 will be added. That's called in your depreciation calculation. So I explain everything how you going to prepare your um, uh, rental schedule, which is here. And when you update it, this will be updated automatically to his wife or who is the other partner of that property. Then you can finalize this called rental property. Now I will go back to that in my original slide and see. So I put in some expenses here. So when you have time, you can enjoy. Now we will move into that non-deductible rental property expenses. Conveyancing fees, when you purchase the assets, conveyancing fees cannot be deducted through that rental expense. It's going to be a part of your capital and you should include as a capital. Initial repairs, after immediately after purchase your property, if you do any repairs, that's not going to be deducted from your rental income. That will be included in your capital cost and you can deduct from your income tax. right? So that's your normal depreciation method, not to that under the repairs and maintenance. Over the time, you can deduct same as conveyancing fees. Improvements, that's part of that your capital. I saw that how you are going to deduct. Stamp duty is part of your capital, cannot be deductible. However, it can be deductible not immediately. You are going to deduct as a capital over the time. It's a capital depreciation. So my apologies. The stamp duty part of that, no, that part of that your capital, right? It's not under the construction or anything. So therefore, we cannot. That cannot be deductible. But capital improvement and initial repairs can be deductible, right? Through the depreciation, because that's a constructions. Stamp duty not going to be a construction or assets, therefore cannot be deductible. However, in ACT, so I would be very careful. I think I mislead that. Stamp duty and conveyancing fees is part of your capital cost. When you sell it the property, that will be used as a cost of your capital, cannot be deductible through that your rental schedule. Even you cannot use that for depreciation. Why? This is your capital. The depreciation for the building is the construction. How much the construction cost, that will be deductible. But the initial repairs and capital improvement, that's your construction or the work. So you cannot deduct immediately, but you can deduct over the time, right? Initial repairs and improvements. So stamp duty, that's the other one. Legal expenses, what you are paying for when you purchase that one, normally that will be included in your capital cost, cannot be depreciated. The travel expenses related to inspecting, maintaining, or collecting rent is not deductible, non-deductible rental property expenses, right? So please note that initial repairs and improvements, it is a constructions, so you could deduct as a capital work deductions. Capital work deductions. Immediately you cannot deduct. Over the years you can deduct. But conveyancing fees, stamp duty, legal fees is not deductible, because that's part of your capital cost, right? It is not the construction cost. That's the way you won't think. The travel expenses related to inspecting, I already explained, we cannot deduct, right? Excellent. Prepaid expenses. So what are the prepaid expenses? Prepaid expenses. So how are we going to understand what are the prepaid expenses? Can you write down in your notebook? So you paid for a insurance 1st of January 2020 to 31st of December 2020. You paid $1,200 insurance payment. Normally we are paying in advance insurance. When you paid your 1st of January 2020, you paid from your business bank account or from your personal account something insurance work related, 1,200. For which period this 1,200? You write down in your notebook, 1st of January 2022, 31st of December 2020. For 12 months you paid in January. You are doing now, you are going to write down, you are going to prepare the tax return for 2019-20 financial year. 1920 financial year, when it's the end? 30th of June 2020. So when that 1920 financial year end? 30th of June 2020, right? So when you prepare that your tax return, so how much expense? What's the 2020 financial year? 1/7/2019 to 30th of June 2020. So you can see that the insurance paid 6-month insurance from January to June for this tax year. That's fine. Other 600 really we paid after that my financial year, because my financial year end 30th of June 2020. But I paid for 12 months. The first 6 months, this tax year or this financial year, the balance 600 really for next financial year. You paid for the future period. You paid prepaid, you paid in advance, right? So normal accounting rule, what we do, you go when you prepare your profit and loss statement, what you are going to do normally, you're going to account only what the expenses related to 1st of July 2019 to 30th of June 2020. So how much that period insurance? The first 6 months, $600. So when you prepare your financial report, you would like to accurately reflect your profit mean, you must put that $600 as a expense, right? That's mean your profit and loss statement going to show $600 as a expense insurance. So when you prepare the tax return, how much you can take it out from your deduction, 600 or 1200? That's a question called prepaid expenses. You paid for the next financial year that $600. Can already I paid today. Can I take it out from my tax return this year, or I want to wait for the next year? That's the question. So normal accounting standard, we want to deduct 600, we want to expense this year $600, next financial year other $600, right? I already paid all $1,200 this year, even if he paid. So the tax rule little bit different from in our accounting standard, so accounting rules. So how we going to manage this one? We're going to use a prepaid rules. The normal rule, you're going to divide based on that number of months related to the insurance and deduct 600. That can be used anytime with the tax or accounting. It's no any issue. But always, client would like to climb more deduction most of the time. So they like to deduct all 1200 what they paid. So that's possible or not. If they satisfy prepaid expense rule, they no need to worry about that 600. They can deduct the whole amount. If they not satisfy the prepaid rule, they only can claim $600, which is relevant to that period, which is relevant to that particular tax year. If they satisfy the prepaid rule, they can deduct the whole 1200 from their income tax return. So now we will come back. So what is the prepaid rule? How are we going to work it out? The tax treatment for the prepaid rules, that depending on the taxpayer, he's an individual or small business entity or that bigger institutions, what kind of expenses, and taxpayer is a small entity or not. So generally, if you not satisfy the prepaid rule, you're going to calculate apportionment, how much exactly for that period only can claim. In our example, we can claim only half of that insurance because 6 months, 12 months you paid, but 6 months belong to this tax period. So divide by 2 and take it that one. And there are three the prepaid tax rules here. One, excluded expenditure. Any expenditure come under this category, we no need to use the prepaid expense rule. You can claim immediately. Second one called 12-month rules. If you satisfy the 12-month rule, you can deduct from your you satisfy in the prepaid expense rule, you can deduct the whole amount. Other ones, pre-RPT rules, very rarely we are applying this rule. There's a if you made an agreement before 20th of September 1999, you could use that rule, but very rare now using this. Almost 10 years gone, we are not using this rule. Not more than 10 years. There are some 10 years restriction, so we very rarely use this rule. So now we will come back to that prepaid rule. So number one, excluded expenditure. If you paid less than $1,000 or including GST $1,100, you don't need to worry about that anything. The total amount can be deductible. For example, if you paid that some insurance $800 for future period as well, so total amount can be deductible. So less than $1,000 or including GST less than $1,100 can be deductible full amount regardless of which period you paid. Even you paid future period, If you already paid this year, you can total amount deductible. How much a threshold? 1,000. Second one, you paying this one to satisfy that state or federal or council legislations that or court order that can be deductible. For an example, you are paying the land tax normally 1 year in advance. Why you are paying? Satisfy the state government law. So that can be deductible. Council rate paying you in advance. Why you are paying that one? For the local government legislation. Some of the levies you are paying under the Commonwealth in advance, that will be deductible. Regardless of how much amount, if you paid to satisfy the territory or that state or local government or federal government legislative requirements, you can fully deductible that your expense. That's called excluded expenditure. Less than $1,000 or because of any legislative arrangement. So your land tax, your emergency levy, your council rate, and everything will be deductible. Why? You satisfy that legislative requirement. Even if you paid in advance, everything can be deductible from your income tax. Right? That's called excluded expenditure rule. Next one, your salaries and wages, if you pay to your employee in advance, that will be deductible. Not the loan, actual wages or salary, if you paid in advance, that can be deductible. Right? Prepaid. So capital, any capital assets, we have a different calculation method, which is we're going to learn in a couple of weeks time. That's called depreciation methods. The depreciation can be deductible as per the depreciation rule what you are applying. Therefore, we cannot use the prepaid rule for that. That's a different rule. We will talk later. Private and domestic, you cannot deduct. Certain amount of general insurance company in connection with the issues of policies or payment of reinsurance premiums are come under excluded expenditure, but very rarely you are going to come across this type of expenses. But mainly you want to these two and salaries. But when you are doing, you can deduct the whole amount if you paid. But the next one, the capital or private domestic, we have a special rule. We will talk later. You can see I put it as an example. John operate a business. He paid for the 1 year. What is that he paid? How much he paid for the truck use exclusive of business purpose? Registration, tax registration. It is going to be a part of the legislative requirements. Therefore, whatever he paid, that's going to be can climbable. Also, he paid only $1,000. He satisfied the both rules, right? This is paid for the state government registration requirements. That's a legislative excluded expenditure as the less than $1,000, 1,000 or less. So he can deduct immediately. He no need to calculate that how much belong to this year or next year. Now we will come back to the 12-month rule. What is the 12-month rule? If you are excluded expenditure, you no need to check the 12-month rule. You can immediately deduct whole amount. But if you not satisfy the excluded expenditure rule, which is we learned a couple of previous slides, you can check that other rule, 12-month rule. Not necessary to satisfy the both rule. If you satisfy the excluded rule, you are done. You can deduct the whole the prepaid expenses. If you not satisfy the excluded expenditure rule, you can come and check the 12-month rule. But the 12-month rule say you can deduct the prepaid expenses if you satisfy the two conditions. What are the two conditions? You should be a small business entity or you should be an individual and that particular expense will be non-business expenditure. What is the non-business expenditure and what is the small business entity? Both we should understand. The small business entity mean businesses with a less than 10 million turnover. There are a number of different definitions in the small business entity in the tax office website, but for this purpose, the less than 10 million turnover business going to be considered as a small business entity, right? So it's clear. Second part, or individual incurring deductible non-business expenditure. Non-business expenditure mean you are an employee or you are an investment property owner. Your expense, what are the expenses deductible? You remember last week we talked about that. Your car expenses, your travel expenses, your other work-related expenses, cost of managing tax affairs, all the stuff we talked. Couple of things last week. That type of expenses called non-business expenditure. Today we talk about that under the rental schedule, we have number of expenses, advertising, councils, and all the expenses, council rates and interest and everything. That's also non-business expenditure. Why? I said that investment property, it is not a carrying the business. Therefore, that's non-business, therefore non-business expenditure. So everybody understand that difference between business expenditure and non-business expenditure. Now we will move into that. If you are satisfied first condition, what is the both conditions should be satisfied. Your eligible service period should be less than 12 months. So we want to understand what is this eligible service period, right? Should not go to more than 12 months. So eligible service period mean your contract period. You paid the insurance for 1st of January to 31st December. So that one, how long, how many months? 12 months. So your eligible period not exceed 12 months. What's the meaning? You are able to climb this year, right? And the eligible service period should be end next year. You cannot have a when you go to more than a year, that you cannot, right? So what that they are saying, so there are three conditions should be satisfied. You should be a small business entity, or you should be a no that you are individual, and your expense will be non business expenditure. Your eligible service period should not exceed 12 months, and your eligible service period should be end in the next year, right? So these three conditions should be satisfied to satisfy the 12 months rule. So you clearly understand what is the small business entity, you clearly understand what is the deductible non-business expenditure, and now we want to know what is the service period and how it's going to be end in the next income year, right? Now, so what is the next income year? The last day of your contract period should be next income year. So how we know that what is the next income year? For example, now 1st of July 2022, 30th of June 2021, this income year. Next income year will start 1st of July 2021 to 30th of June 2022. So that's the next income year. So your contract should finish, so your eligible period should finish at least next year. If you go to beyond the next year, you cannot use the 12-month rule. You cannot use the 12-month rule. So now we will work it out, couple of examples. So 12-month rule, if you not satisfy the 12-month rule, if it is not excluded expenditure, the both rules will be not satisfied. You only want to do apportionment. Apportionment mean how many days that belong to this year, how many days in the total period, and work it out. So for example, 12 months you paid, you use the number of days. Non-business expenditure, I clearly explained. Non-business expenditure mean you work as an employee, whatever expenses you can deduct from your income tax, that's a non-business expenditure. Or if you're carrying an investment property, whatever rental property expenses we talked today, that all that expense is going to be non-business expenditure, right? Non-business expenditure. So I did not explain to that little formula, don't confuse. So what we are trying to say, if you not satisfied the 12 months rule, now we are normally using in our accounting rule. So you're going to check that how many days that particular amount belongs to this financial year, and based on that you're going to calculate. For example, if you paid for 365 days for insurance $1,200, how many days for this financial year? Say 180 days. So 365 total days in eligible service period, and days in the eligible period in this income year 180 multiplied by what is the expense total, 1200 in our questions. So 1200. I will show you this formula through example in a minute. I'm sure that you will understand through the example. So what is the eligible service period? So that's one I did not explain previously. Normally your contract date. You are getting insurance from 1st of January to 31st of December. That is your eligible service period. What is the contract date? What the end date? Right? That you paid for insurance for 12 months from 1st of January 2020 to 31st of December 2020. That's your service period. However, if you paid late, you can say your late the payment date or contract date, whichever late, that's your start date. What they're saying, the period, eligible period begin day under the general agreement begins. That's when I said that 1st of January to 31st of December. That's the start date will be 1st of January, normal rule, but the agreement done, or payment date. Actually, what the date you paid, which is the later. For example, your contract, can you write down? Surely it's a little bit confused. Your normal contract for insurance, 1st of January 2022, 31st of December 2020. Right? That's your contract period. That's your eligible service period. For this is your insurance contract. However, you paid 1st of February 2020, you payment you made. Contract is there when you made the payment 1st of February 2020. In that case, your eligible service period will be 1st of February 2022, 31st of December 2020. Everybody understand? That's called eligible period. What the day you paid, that's the day is coming as a start date of your eligible period, eligible service period. So everybody clear now? So normally, very, very rare the type of circumstances, you can say what is the service period mean? What the day the contracts begin and end, right? So that's a end date will be at 10 years or less. That where they are more than 10 years contract, we are normally involved with that 1 year, right? So you can see a business they are running 1st of December 18, might make a payment to the lease to cover 1st December to 31st December 2019. Question number one, the lease is excluded. So we want to, so what is that example? You want to apply prepaid rule for this, right? Example. Step one, always in your mind should go to that excluded expenditure. Lease is less than $1,000. We have no information here, so we cannot say anything. Second, this is anything territory related one. No, lease is just normally a rent, which is a normal expense, not a council rate or land tax kind of stuff. So not excluded. Salaries and wages, not no. Is a capital nature or private nature? No. Therefore, we cannot apply excluded rule. Now we will come back to the 12-month rule. Assume that Mike, a individual person or small business entity. That's fine. We can tick the box. Second one, how many days that the service period should be? Less than 12 months. How many days here? 1st of December to 31st of December, more than 12 months. Therefore, we cannot use the prepaid rule for this one. Why? Very clearly say it is 396 days. Over 365 mean you cannot use that, right? Prepaid expenses immediately. The Jacob Trust, a small business entity on 1st of June 2019, and that you can read it, that all the details. He made a payment for 24,000 to cover lease of a business premises for 12 months commencing from 1st of July to 30th of June. Excellent. Now we can see he paid that prepaid expenses, right? So what is the service period? So you are preparing the tax return for really that 1819, right? 1819 tax return you're preparing, right? So step number one, what is this? This is the one, anything excluded expenditure? No, this is a payment lease. It's not going to be excluded expenditure category. So only thing we want is check the 12 months rule. Yes, 12-month rule. Step number one, this is a small business entity. Yep, that's good. So tick that first point. There are 3 points, right? Second one is the less than 12 months service period start. When's the start service period? 1st of July to 30th of June. So less than 12 months. Excellent. Because we paid in June. So that 1st of July to that contract period is really 12 months. That second conditions met. Third condition, this particular that contract end next tax year. Yes, 30th of June end. 30th of June is the last day of the next tax year. So therefore all three conditions met. If the all three conditions met, what we can do, we can use the prepaid rule. We can deduct from a whole $24,000 from the 18-19 financial year, not 1920. 1920 everyone can deduct, but that's called prepaid expenses. 1890 we can deduct. So second one, other example, Tom Private Limited, a small business entity, so they paid $15,000 for to cover that uh, uh, advertising cost from 1st of June 2019 to 30th of June 2020. All right. So step number one, this is the advertising, not the excluded expenditure. So only we can test that 12 months rule. The small business entity, yes. What is the eligible service period? 12 months? No. You can see 1st of June 2019 to 30th of June 2020. Therefore, that's over 12 months, almost 396 days. We cannot use that prepaid expense rule. Only thing you can, portionment. So how are we going to portionment? 18-19 financial year, you're going to see 1st of June to 30th of June. That period, how much? The total eligible service period 396 and 15,030 days in that particular financial year. So you can deduct only 1,136 from 18-19 tax return. And next year tax return, you could deduct the balance. You can see next year, you're going to deduct the 366. This is the formula we talked previously, right? Number of days and divide by how much of that service that particular financial year belongs to. So why we are doing like this? We are not satisfied the 12-month rule. If you're not satisfied the 12-month rule, we want to apportionment. We want to part that how much for this financial year, how much for next financial year. Right? That's called prepaid expenses rule. You can see total deduction has happened. All 15,000 is deducted, but little part for this year and other part for the next financial year. If you're not satisfied the prepaid rule, this is the way we want to deduct. Deduction non-business expenditure. All right. There are a couple of examples here. So Jasmine, he's a solicitor. So he's not a small business entity, but he's an employee, right? So he's an employee mean he is able to use this rule. So step one, what is the service period going to be? So can we exclude an expenditure? Subscription is not excluded. Therefore, we want to check that. Number one, you can very clearly say the period of subsidy wholly with a 12 months period ending before last day of the next year. So Jasmine can deduct the whole income, whole 1,750, 18-19 financial year. So here you can see it is go to more than 396 days. So then you want to do the portionment, and what is the that period of that one will be first part, and next year you can deduct balance. It's here. So you can just do the practice while you are having the time. So RP registration mean, as I said previously, if you have an agreement before 21st of September 1999, that request make the payment, return to something to be done under this agreement, that can be deductible. That's a prepaid expenses, but very rare. Some payments come because of somebody made the agreement before 21st of 1999. How long we are now? Almost at 1999 to that we are in the 2021. All right, after very rare, but this come up, we can use it. Right. We will use tax related expenses. I already explained very clearly in our all the cost of managing tax affairs can be deductible. I covered in the last Alexis, so last workshop, so you can read it out from the last PowerPoints or here some information. PAYG withholding or PAYG installment will be not deductible for both business as well as individual. Sometimes they may say, I paid this much of tax, can you deduct? No, that's your tax advance, right? You paid your PAYG in advance, your PAYG installment in advance. Therefore, that's not going to be a deduction. That's your liability amount you paid in advance. We calculate the tax, total tax liability, and how much you paid, you will take it out from the tax balance you're going to pay. So therefore, PAYG installment or PAYG withholding is not a deduction. Now, sometime the question will come up, as a business, we are paying that PAYG withholding on behalf of employee to ATO, right? We are paying to the PAYG withholding on behalf of employees to ATO. That's really going from your bank account. So can I deduct from my income tax? Answer is no. So even though you are paying for the employees, that PAYG withholding already included in your gross wages. You are deducting that PAYG withholding component included in the wages. For example, your employee's salary $1,000 and you pay to that employee only $800. Maybe $200 you taking as a PAYG to ATO. So $800 you give it to that employee, $200 you gave to that ATO. The total $1,000 it's included in your wages. Your wages will be cross wages, not net wages, right? When you see that in your accounting system, so we are including cross wages. So total wages you are taking out from your income tax as a deduction. Therefore, PAYG withholding is not necessary to deduct again. Otherwise, it's going to be a double deduction, right? Otherwise, going to be a double deduction. So PAYG withholding or PAYG installment is not deductible for the taxpayers. That's a normal rule. That's a tax liability you paid in advance. For the business, the PAYG withholding already included in the wages. Therefore, no need to deduct again. One more time. So double deductions are not allowed. Next one, payment of other taxes. Sometimes we are confusing. This is the taxes we can deduct from our income tax or not, right? Are deductible. The payroll tax, one of the tax established by state government authorities like a state revenue department, like a Revenue Victoria, Revenue New South Wales, and Revenue South Australia, or Revenue Tassie or Queensland. All the states have a revenue department to collect the payroll tax. Payroll tax different from other taxes what we are doing like a state, the federal government taxes, right? So the payroll tax belongs to state government. So there's a special tax. So your employer, if they paid more than 600,000 in a year for their wages for the employees as a 1 year total wages, not the each individual employees, together how much your wage bill, how much your salaries and wages total. So if this goes above 600,000, you are required to pay 4.95 percentage of that above amount. For example, total wage bill for this year, $800,000. So how much payroll tax we should pay? So whatever amount above 600, 200,000 only above the 600. So 200 times 4.95 percentage. There are a number of concessions this year, number of changes in the payroll legislation, but I am just explaining the general rule. So anything threshold is 600,000. If you pay in total wages in a year more than $600,000, you are required to pay the payroll tax for whatever amount above 600. Can you write down in your textbook? For example, in your employer paid $800,000 the salaries and wages this year for all of his employees, all of his employees. Now he may be required to pay the payroll tax to the state government department. So how much he should pay? Normal rule The threshold is $600,000. So total 800 minus 600, $200,000 times 4.95 percentage. That's the amount of payroll tax he must pay to revenue department of that state. So that expense will be deductible from income tax. This is not the PAYG withholding. This is not the PAYG installment. This is the additional tax what is paying to that state government department. So it's deductible. Second one, French benefit tax. General rule, French benefit tax will be deductible unless there are something involved with the entertainment and etc. So you remember the last time we talked about that the director gave the diamond necklace to his secretary through the business expenses. That 25,000 will be deductible from income tax. Now, the ATO may be not happy because that he may be fall under one of the other tax legislation when he gave the diamond necklace. Therefore, the 25,000 what he gave that one, he may be fall under French benefit tax legislation. And he required to pay French benefit tax. How much he want to pay? Normal rule, there's a different calculation method for this diamond necklace will be 25,000 times 2.0808 times 47 percentage. If you calculate it, it's around $24,450 or very close to that number, right? I cannot say exactly. 24,000, 24,500, say like that, very close to that number. So you see $25,000 diamond necklace that's gone from the bank account. Again, you want to pay to ATO other 24,500. So 25 plus 24,500, the total expense for that diamond necklace, 49,500. So now question is, first 25,000 we can deduct from our income tax. That's right. And that we discussed previously. Now 24,500 this French benefit also deductible from income tax, right? The French benefit tax deductible. Most of the other taxes like a land tax and council rate and emergency service levy, everything that related to the business or rental property will be deductible, right? Repair and maintenance, right? Repair and maintenance and improvement. Repair for your plant and equipment, your capital assets, normally you do some repairs. If you do the repairs will be deductible immediately, right? For example, if you did the repairs, that can be deductible immediately. However, if that repairs is an improvement, that cannot be deductible immediately. You must use that your depreciation rule and deduct over the time. So as a tax consultant, so as an accountant, we have the challenge, which one is repair, which one is improvement. Accounting purpose, you may say this is repairs, it's not necessary repair for tax purpose. So we should understand what is the tax legislative arrangement or what's the tax rule, which repair, which is the improvement. So what does a repair mean? Under the tax legislation, anything you fix the defect. If you fix the defect, that's going to be repair. If you replace the asset or replace the whole asset, going to be improvement. Now we will see one example. For example, in your tenant damage a carpet, right? So your client have an investment property, the tenant damage a carpet. The carpet damage for 2x2, right? 2x2 square meter is damaged. So you ask to the tradie to come and look into that. He look into that carpet and say, yeah, this is a over 20 years old carpet. This particular carpet not produced in Australia. We cannot get the same color carpet. However, if you want, I can import from UK, which will cost you $5,000 to replace. 2x2, I will order from UK. They can specially manufacture for you and send it to us, and we will replace. That will cost you $5,000. Very expensive for that your client. Client asks, what is the option? Other option? Yeah, I can remove this all the carpet and replace the whole new carpet with a different color and different material, and that will be cost you $2,000. Right? The first one, 5,000. Second one, $2,000. Right? The second, what they are going to do, they can remove the existing carpet and put the new carpet. Right? So when we show into that, what is the tax treatment for both cases? That if you order that carpet from UK and specially made and fix it that 2x2 in little spot, that's called repair. All the 5,000 can be deductible immediately from your income tax return because you fix the defect. Second one, that you replace the whole carpet, that even though less amount, that going to be considered as an improvement, and that cannot be deducted immediately from your income tax. That can be deductible over the time using the carpet maybe 10 years. So 2000 divided by 10 years or diminishing or prime cost method, we will talk later, and every year little you can deduct next 10 years. Right? It's unfair, but that's the way it's work. It's a material not available is not a reason to determine this is repair or not. For example, in our this particular example, that contractor come and said that sorry, this carpet is no more here in Australia or anywhere in the world. Only option for you to replace the whole $2,000. You cannot argue there's no material. That's why I replaced the whole stuff. That argument will not satisfy that repair or improvement. That's going to be an improvement, right? But I'm trying to say you cannot argue there's no any other material available in Australia or anywhere in the world. That's why I replaced the whole carpet. Therefore, I want to consider that one as a repair. That argument will not applicable for determine the repair or improvement. You replace the whole carpet, therefore we're going to consider that one as a improvement. That's the way the tax rules work. So I understand. I think you understand what is the repair now. However, I have a good example. One of my students asked the question. He purchased a car. Well, he's a student. He's using the car for delivering the pizza. Right, fully that's a business purpose car. Business means his work related car. He purchased for $600, and when he one day when he deliver the pizza, that police stop him and said, they said that your car all four tires are teared off, you cannot use it. You park the car here and you must change that all the four tires and come and report to the police before driving the car, before driving further. So what happened, he went and changed that all the four tires, which is cost him around $500, and whole tires are replaced. That's a very important terminology here. So that's $500 his total tire cost, $600 car. Now he's able to sell this car for $1,300, right? Because when he changed that tire, this car values increase up more than that actual cost. So his question is, I think masters or PhD student, his question here, how much I can deduct immediately, right? So what do you guys think? That we replace the whole asset same as the carpet. Therefore, can we use as an improvement? No. But the tire is different from the carpet, because you cannot just not repair the tire if it's fully waved off. You cannot use the tire. That's what police said. So you cannot put it anything top of that and make it to run, right? Only you can do your repair way the tire if it's fully gone. Only thing you can put the new tire. That's the way we do, right? Therefore, that can be used as a repairs, right? Because there's no any other way normal people do the repair for the tire, right? In Australia, your tire is gone, you want to go and put the new tire. Therefore, that can be considered as a repairs. So your brake pads, changing the brake pads, changing the tires, even your whole replacement, that can be considered as a repairs, because that's the way normally we do, right? So that no any other option for you to do that, right? Good. So now the third part Any immediate repairs cannot be considered as an immediate deduction. For example, your pizza, the student, he purchased a car for $300, right? For an example, he went straight away to the mechanic shop. He did that all the repairs. Repairs cost $1,500. Actually repairs, not anything. He changed the tire, he put the brake pad, he put the new oil, and all these things he did that. That's everything's are repairs. However, cannot be deductible. What they are saying, any asset you purchase immediately after, before producing any income, if you did that some repairs, that should be treated as a capital. You want to deduct that expenses over the years. Cannot be deducted immediately from your income tax. That's called repairs. Excellent. So I just put it everything here. Minor degree incidental, like a change in the tab or that type of things, can be deductible immediately. Lease expenses, as we said, that any rental, property, when you are doing the lease expenses, that can be deductible from your income tax, right? However, that everything capital rated purchase, that may be included in your capital cost. Specific deductions for borrowing, I already explained. Before getting the loan, you maybe spend some money on this type of expenses, loan establishment fees, or lender's mortgage insurance, stamp duty, and etc. This is come as a borrowing expenses. These expenses can be deduct from your income tax. However, there's a specific rule. Your expense exceed less than $100, immediately deductible. If you're over $100, you want to deduct over the 5 years. Over 5 years. Please note that interest expense, not a borrowing expense. Whatever amount of interest you spend on your business loan or your investment property loan, total amount can be immediately deductible regardless of this $100 rule. $100 rule only applicable to expenses I listed in that first line. You can see loan establishment fee to valuation fees up to that point, right? I saw an example here. You can see how you are going to calculate. So total borrowing expenses $500. So 1st of August 2018 for 4 years loan for the rental property. So you are going to do the 4 years because the rental property only 4 years. In that case, you can deduct only the 4 years. What they're saying for 4-year loan. So which one? Maximum of 5 years or loan period. Loan period 4 years mean you're going to use the 4 years rule and deduct that one. If the loan period 6 years, you're going to use that 5 years, right? That's the way we're going to do. That's the borrowing expenses. Mortgage discharge, whenever you discharge your mortgage, whatever that discharge fees or any other payment you make, surcharge, that can be deductible from your income tax, right? Bad debt. The bad debts, we all know that whatever amount you cannot recover from the customer. When we do the credit sales for the loan, or when you do the credit sales, sometimes customer may be not pay back to you. That's called bad debts. The customer not paying back to mean you can deduct from your income tax. However, you can see the bad debt mean debt is actually bad, cannot be doubtful debt. So how we going to decide whether they're actually bad? You're going to make sure that that client is not going to pay for me, right? How are we going to make sure? If the client is a bankrupt, you can say, yep, that's right. We don't need to. We can put as a bad debt because very rare to get it. That your company is insolvent, you can say client not going to pay, therefore I am going to deduct from my income tax. Or small expenses, you want to take reasonable steps to recover that amount. All the reasonable steps are failed, you can say this is bad, that client not going to pay, I am going to deduct from my income tax, right? This is called bad debts. Bad debts mean that somebody that buy from us for a loan, for a credit, they did not pay back to us. If they not pay back to us, we can claim from in our income tax. So now I use the word reasonable step you take. So for an example, $100, somebody want to pay for us, you send a couple of emails, You call a couple of phone calls, still you couldn't get it. It's not worth. You can say that's bad. $5,000 somebody not paid. You call couple of calls, couple of emails, not worth. That's not reasonable. You should go to next level. What is the next level? Debt collecting agency. Debt collecting agency come back and said, sorry, we couldn't locate him. Cannot we cannot recover. Now you can deduct, because for $5,000 going to the courts is not much worth. You maybe spend a lot of money. Third one, 500,000 client did not pay. You send the email. You use that debt collecting agency. Now you must do that legal action, because this is a significant amount. So the courts failed and said, sorry, we couldn't find it out that person is no more in this country. In that case, or they will make him as a bankrupt. In that case, you can deduct from your income tax. That's called bad debts, reasonable action to make it as actually bad. So so somebody come and theft or losses can be deduct from your income tax as a deductions. Political donations restricted to that 1500 for individuals, not driving from the business. However, 1st of July 2018, gift and contribution made by taxpayers driving income from the business, not deductible. For individuals, 1500 will be deductible. Mains electricity connection 46 45. Right? So when you have the infrastructure between your home to the infrastructure, not just a changing the provider, infrastructure when you're building the house, so that will be deducted 10 installments over the 10 years, right? So $12,000 you spend on that infrastructure, $1,200 equal installment, divide by 10, right? Excellent. We are going to stop at this point. I know that substantiation and tax losses are in this PowerPoint slides, but we did not follow today. I stopped at this one. I think Peter may be covered, or other lecturer may be covered a little more, but I will cover that one in the next week. Substantiation requirements and tax losses we will enjoy in our next week classes. Thank you, everyone, and looking forward to see you next week. Going to be a uh, long weekend, so you guys enjoy your long weekend and see you and week after. Thank you.